Welcome to the Deep Dive. Today we're jumping right into the John Deere Q3 2025 earnings call. On the surface, it looked, well, pretty solid for them. They reported GAAP EPS of $4.75, and revenue was just north of $12 billion. Both of those actually beat the consensus estimates.
That's right, a clear beat on both top and bottom lines. But if you were watching the market reaction, well, it wasn't exactly celebratory.
No, definitely not. Despite those beats, net income actually dropped significantly, down 26% year over year, landing at about $1.29 billion.
And that led to a pretty substantial stock price drop right after the announcement, a real head-scratcher for some, perhaps.
So what gives? Well, the main driver behind that negative reaction wasn't really the Q3 numbers themselves. It seems to be the fact that the company narrowed its full-year net income guidance.
Exactly. It signals a more cautious outlook than maybe investors were hoping for. It suggests they're, hunkering down for some continued headwinds.
Okay, so let's unpack this. Diving into the segment performance is usually where the real story unfolds.
Absolutely. The breakdown gives us a lot more color. Let's start with production and precision ag. Sales there declined 16%.
16%, okay. And profit.
Operating profit got cut basically in half, down to $580 million. That pushed the margin down to 13.6%.
Ouch. What drove that?
Mostly lower shipment volumes. And interestingly, a little bit of negative price realization, just under 1 point. They attributed that negative pricing bit to using incremental pool funds.
Pool funds. So that's them helping dealers move used inventory, right? Giving incentives.
Yeah, essentially buying down interest rates or offering other support to clear out that used equipment backlog. It impacts the reported pricing.
Got it. Okay, how about small ag and turf? That usually holds up a bit better.
And it did, relatively speaking. Sales were down just a modest 1%. Operating profit dipped slightly to $485 million, but they kept a healthier 16.0% margin.
And pricing there.
Actually saw about half a point of positive price realization. So a different story than in the large ag side.
Interesting contrast. Now, the heavier stuff, construction and forestry.
That segment saw sales decrease 5%. Operating profit landed at $237 million, which is a 7.7% margin.
And pricing must have been tough there, too.
Yeah, they reported negative price realization of just under 5 points, driven mostly by incentive programs and, competitive pressures, especially in North American earthmoving.
Wow, almost 5 points. But wasn't there a glimmer of hope in that segment?
There was, actually. A bit counterintuitive, maybe, but retail settlements in North American earthmoving, so actual sales to end customers, were up mid-single digits year over year.
Mid-single digits up. After how long?
That's the first increase in 18 months. And on top of that, their order books for construction and forestry were up mid-teens year over year.
Okay, that is a potential green shoot. Does that feel sustainable or just a blip?
Well, the combination of rising retail and rising orders, it suggests maybe a genuine inflection point. Even if they need incentives now, it points to some underlying demand firming up. Could be turning a corner there.
Fascinating. Okay, and the last piece, the quiet hero maybe, financial services.
Definitely bright spot this quarter. Net income there increased a very healthy 34% to $205 million.
And what drove that jump?
Primarily lower provision for credit losses, plus some comparison effects from prior year special items. It really shows the value of that diversified model, helps smooth things out when equipment sales are choppy.
Absolutely. Okay, shifting gears. Let's talk about the big picture headwinds. Tariffs are a recurring theme. How bad was it in Q3?
The tariff cost in Q3 alone was around $200 million. That brings the year-to-date total to roughly $300 million.
And the outlook for the full year?
They actually adjusted the forecast upwards. They now expect the fiscal 2025 pre-tax impact to be nearly $600 million.
$600 million. That's a staggering number. Where's that increase coming from?
Mainly increased rates on imports from Europe, India, and on steel and aluminum. Management pointed out these costs hit their decremental margins, meaning profits shrink faster than sales fall.
Yeah, that leverage cuts both ways. They need some stability there, I imagine.
They really emphasize that. Stable tariff regimes are needed before their own mitigation efforts can really take hold effectively.
Okay, beyond tariffs, the other big challenges. Used equipment oversupply and high interest rates. Still major pressures.
Definitely. Still pressuring customer demand. Similar to maybe buying a car right now, those rates bite.
So how are they tackling that specifically? We mentioned the pool funds.
Right. It's a multi-pronged approach. Disciplined inventory management is key, which we'll get to. And those pool funds are being used strategically. It's not just discounts. They mentioned innovative things like split rate financing.
Split rate, how does that work?
Essentially, the dealer buys down the interest rate for maybe the first 2 or 3 years of a 5-year loan on used gear. Makes the payments much more palatable for farmers up front. Helps keep that trade cycle moving.
Clever. And are these efforts actually working? Are inventory levels coming down?
Seems like it. They shared some pretty significant numbers. Used inventory of late model large ag tractors and combines down over 10%.
Okay, that's good progress.
And used sprayers in North America are down 20%, planters down over 30% since the start of the fiscal year.
Wow, planters down over 30%. That's substantial. What about new equipment?
Similar story. New inventory of North American big tractors, 220 horsepower and up, down 45% year over year. Combines down 25%.
45%, that's aggressive inventory clearing.
It is. Small ag tractors under 100 horsepower also down 30% year over year, 15% just since last quarter. And North American earth-moving field inventories are 25-30% lower year over year.
So they're making real headway. How does their production strategy fit into this?
This is where it gets really interesting. They're intentionally aligning production with retail demand. But more than that, they're actually underproducing in small ag and construction and forestry this fiscal year.
Underproducing. By how much?
About 10% below expected retail demand in those segments for FY25.
What's the strategic thinking there? That sounds very deliberate.
Oh, it absolutely is. It's about prioritizing long-term market health and pricing over just chasing volume right now. By building less than they sell this year, they accelerate clearing out existing inventory, both theirs and the dealers.
And that sets them up for
a potential tailwind heading into FY26. They expect to build in line with retail demand next year. So if demand is just flat, production still gets a bump because of this year's underproduction. Positions them well for the eventual recovery.
Smart play in a cyclical industry. Okay, let's talk tech. Deere keeps investing heavily in precision ag and automation. Are these tools gaining real traction?
They highlighted some pretty tangible results. Their See and Spray technology on the 2024 models, showing 30% more acres of use this year. Customers are actually buying additional units for their fleets.
That's a strong endorsement. What else?
Harvest Settings automation early reports suggest over a 30% increase in throughput. That's bushels per hour, so getting the crop in faster. And predictive ground speed automation, showing over a 20% boost in machine productivity, measured in acres per hour. These are real dollars for farmers.
Those are significant efficiency gains. And connectivity is key for all this, right? Especially out in the fields.
Exactly. Their satellite solution, JD-Link Boost, has passed 5,000 global orders in its first year. Over 1,000 in the US, Canada, Australia, and New Zealand.
And crucial for places without cell service, like Brazil.
Hugely important there. They mentioned something like 70% of acres in Brazil lack reliable cell coverage. So this unlocks precision ag potential in massive markets.
Wow, 70%. That's a huge opportunity. How about getting new farmers into their system, the operations center?
Their Precision Essentials bundle, sort of the foundational tech package, has seen 21,000 global orders since launching last year. That brought over 2,400 new customers into the John Deere Operations Center ecosystem.
So expanding the user base and existing users.
They saw a 35% increase in engaged acres and almost a 50% jump in highly engaged acres. Globally, there are over 485 million engaged acres now, with 30% highly engaged.
Impressive platform growth. And it's not just for farms.
Right. The Operations Center for Road Building has more than doubled its active organizations to nearly 3,000 over the year. Shows the tech adoption is spreading.
Okay, zooming back out, regional demand for the rest of FY25. What's the global picture look like? Are things tough everywhere?
Definitely seeing divergences. The US and Canada remain challenging for large ag equipment. They expect sales down around 30%.
30%, still feeling the pressure.
Yeah, high rates, used inventory, trade uncertainty. Small ag turf down maybe 10%, construction down 10-15%. But they did note some improved sentiment, better than expected retail in turf and compact utility tractors, and some Midwest dealers saw more quoting activity.
Okay, so maybe some stabilization even in North America. How about Europe?
Europe's outlook actually improved. They now see it flat to down 5%, driven by good dairy prices, better outlook for crops, and maybe stabilizing interest rates there.
That's a notable improvement. South America, Brazil specifically.
Projected to remain flat. There's some cautious optimism, record crops, better farmer profitability, but still tempered by high rates and trade questions.
And Asia.
Asia also improves slightly, now forecast flat to up 5%, mainly thanks to a better tractor market outlook in India.
So quite a mixed bag globally. Okay, last piece of forward-looking data. The early order programs, the EOPs for model year 2026 equipment. What are they telling us?
Right. This is our first glimpse into next year's demand. For sprayers, the EOP closed in mid-August. Orders are projected down roughly 20% year over year for MY26.
Down 20%. Why the difference there?
Management noted sprayers are kind of on a different cycle. They see sprayers as being in year one of a down cycle, whereas tractors and combines are maybe in year two.
Ah, okay, different replacement timing. What about planters?
The planter EOP opened in June, runs till end of September. Ordering there is described as cautious. Customers keeping their options open given all the uncertainty. Makes sense.
Yeah, understandable. And combines.
Combine EOP just opened early August, runs through mid-December. They said early returns are positive, but it's very early days.
And pricing on these new models, are they still getting price increases?
Seems so. List price increases for all the active EOPs are between 2% and 4%. And they specifically set model year 2026 large tractor pricing at about 3% higher year over year.
Interesting. Still able to get some price even in this environment. Speaks to their brand, maybe the tech value.
Absolutely. Yeah. Now, during the analyst Q&A, a few things really stood out. That discussion about producing in line with retail demand next year.
Right, after underproducing this year in small ag and C&F, that really hammers home the setup for FY26, doesn't it?
It really does. It suggests that built-in tailwind we talked about, even flat retail could mean higher production volumes for Deere.
And the Q4 outlook for production and precision ag implied some positive pricing. How does that square with the Q3 negative?
It's mostly timing. They start shipping the new model year 2026 sprayers in Q4, which carry that 4.5% average price increase. Plus, they mentioned improved pricing dynamics in Brazil contributing too.
Okay, mix and timing. What about cash flow guidance? It still seemed like a pretty wide range, $4.55 billion, with only 1 quarter left.
Yeah, that definitely reflects the uncertain environment they're navigating. But management sounded confident in their inventory management, suggesting they feel they have control over a big piece of that cash flow equation.
And their confidence in construction and forestry seemed quite high, despite the current margin pressure.
It did. They pointed to those improving order books and retail sales we discussed, and also the potential benefit from bonus depreciation as we get towards the end of the calendar year, potentially pulling some sales forward.
Good point on the tax policy angle. What about AI? Is it just buzzwords, or is it actually in their equipment?
It's definitely in there. See & Spray relies heavily on machine learning, which is a form of AI. They're also investing heavily in analyzing all the data coming from the operations center to generate AI-driven insights for farmers down the road.
So it's present and growing. Back to tariffs for a second, that $600 million impact. Did they break down where it's hitting most?
Yeah, roughly half is from Europe and steel tariffs. Another third or so from India and Japan. They're mitigating where they can USMCA certification, making smart sourcing changes, but repeated the need for policy stability.
And those pool funds, again, just to clarify, they directly help dealers offer better financing on used gear.
Exactly. It helps buy down interest rates, makes the used equipment more affordable for the next buyer, and keeps the whole trade cycle for farmers flowing, which is crucial in this high-rate environment.
Makes sense. So wrapping up the headwinds and tailwinds, customer caution is real, driven by trade, commodity prices, macro uncertainty.
Right. But there are potential positives offsetting that. Trade frameworks evolving, tax benefits like bonus depreciation, renewable volume obligations, RVOs supporting biofuel demand, E15 ethanol support, plus the expectation of another large crop harvest. Lots of moving parts.
Okay, so boiling it all down, John Deere painted a picture of really disciplined execution facing some pretty serious headwinds.
Absolutely. The market reacted negatively to the guidance tweak, no doubt. But the company seems laser-focused on what they can control: inventory, costs, and pushing forward with their tech investments.
It feels like they're building resilience, positioning themselves for whenever the market conditions finally turn. They really stressed being structurally improved.
Yeah, they've managed cycles before. They explicitly said it's in their DNA. And the aggressive inventory moves, plus the tech differentiation, they believe, positions them to outperform past cycles when the upswing comes. Playing the long game.
Okay, time for our This Is Not Financial Advice segment. Let's throw out an outrageous but plausible trade idea based on everything we've just discussed.
All right, let's hear it.
Despite the stock dip and the near-term caution, consider a long position in John Deere stock, DE. The bet is on the eventual cyclical upswing, but importantly, an upswing augmented by these structural tech changes.
Okay, make the case.
The rationale is multi-layered. 1. They've aggressively cleaned up inventory, especially late model used gear. That was a huge drag. Clearing it sets the stage for healthier sales when demand returns. 2, the strategic underproduction this year isn't weakness, it's setting up that FY26 tailwind. They could ramp up faster than people expect. 3, and maybe most crucial, the tech. See and Spray, JD Link, the Ops Center. This isn't just heavy iron anymore, it's becoming an ag tech solutions company.
Delivering real productivity gains, as we discussed, 30% more throughput, 20% more machine productivity. That stuff matters to farmers.
Exactly. It's becoming indispensable. So the idea is the current market reaction is focused on the short-term guidance. It might offer a chance to buy into a company that's navigating the cycle well, has strong controls, and is building a powerful tech moat before the macro environment fully improves and triggers that next big CapEx wave. See beyond the quarter, focus on the multi-year evolution.
It's definitely a thesis based on looking through the cycle and betting on their strategic execution and tech leadership paying off longer term.
Indeed. And that leads us perfectly into our final provocative thought for you, the listener. As agriculture gets more and more deeply intertwined with data, automation, precision tech, will those traditional boom and bust cycles that have always defined companies like John Deere fundamentally change?
That's the big question, isn't it? Are we seeing the start of a more stable, maybe even recurring revenue-like model emerge, driven by tech and data?
Or is it simply a very well-managed company using cutting-edge tools to navigate a familiar, tough cycle more effectively than ever before? Something to ponder.
A great question for the future of the industry and for anyone investing in it.
And on that note, thanks for joining us for this deep dive into John Deere's quarter. We'll catch you next time.